Cathie Wood here again, ARK Invest. It's been an exciting month, 2 months, lots going on, markets more volatile, lots of rotation taking place. So we'd just like to share with you what we're thinking. As you know, our time horizon is a 5-year time horizon, but we do have a point of view about the backdrop, the investment backdrop, and we'd like to share those points of view with you. So we'll start with monetary policy, fiscal policy, the economy, the market, and just a few thoughts about innovation. So first, monetary policy. M2 is up 27%, so we've seen an acceleration. And this week, just listening to Chairman Powell, Chairman of the Fed, it seems like he's very focused on unemployment, the 10 million jobs still lost relative to pre-COVID, as well as homelessness. It seems, and I've never heard a Fed chairman really focused on homelessness, so a social issue. So for me, that's maybe a little off topic. We all care about it, but what we really want him to focus on is inflation and maintaining economic growth. And I would say if the Fed keeps inflation under control, and I'm not sure it's exactly in the Fed's control anymore, but if inflation does stay quiescent, then I think real growth is going to be fairly strong. Um, we did get some inflation indicators this week, actually today. The PPI came out. It was much stronger than expected. It was up 1% month to month. This is not a year over year number, 1%. So annualized, that would be double digit, and that does sound scary. Uh, on a year over year basis, I believe we're at 4.2%. So we know that we're in the middle of what's called the base effect. Last year, we had declining prices as we entered the COVID crisis. And the declines lasted for several months. So now, year over year, we're going to be comparing against negative numbers. And so on the CPI, we believe, and we've been saying this for some time, that inflation will uh, probably increase to the 3 to 4% range. It was 1.7% in February. And on the PPI, we'll probably see it accelerate on a year over year basis to the 6 to 8% range. Now, the Fed has said that it's expecting this. It's not going to react to it, and we believe them, especially given Chairman Powell's focus. So, and I think the markets are taking this quite calmly. Actually, maybe the anticipation of it caused the huge increase in the long-term Treasury yield from zero point 0.9 at the beginning of the year to 1.75. Perhaps, but when I get into the fixed income markets a little later, we think there might have been something else behind that move. So stay tuned. Fiscal policy. We just got the read on outlays for last month, up 63%. Federal outlays up 63% on a year over year basis. And the deficit is annualizing at about $4 trillion. So that's quite a significant deficit, and and clearly we're going to see a continued increase in the deficit because now President Biden would like a $2 trillion infrastructure bill. So we've just begun. We've never seen spending like this so consistently, from crisis spending to infrastructure spending. And we know we're going to have to pay for this somehow, sometime. And I think that the markets are going to enter a very confusing period as we try and sort this all out. One of the responses to the deficit, of course, is talk about taxes. What we're seeing so far is more on the corporate side in terms of proposals that are being taken seriously, at least. The corporate tax rate going from 21% to 28%, it doesn't seem like it will go up that much. The compromise seems like it's going to center on 25% with a disproportionate hit to companies with branches abroad, so foreign taxes. And so the incentive, of course, is to bring more business back home. Uh, on the individual side, we know that the aim there is to focus on the wealthy, over $400,000 in income per year. And we'll see how that plays out. I think what is shocking to many of us is what some states are doing in terms of taxes. So I think the migration from the high tax states like New York, Connecticut, New Jersey, California, I think the migration that COVID sparked, I think that's going to accelerate. And I think there's going to be some real turmoil in the states that are no longer attracting capital or people. Uh, so I think New York State this week proposed a 14.8% tax. That would be the highest in the nation and a real turnoff. We've seen the exodus from New York and Connecticut to Florida. We're getting a lot more evidence that this is accelerating. And even ARC itself is thinking about alternatives. I think that's something to watch. On the economy, um, so February, if you looked at the statistics from February, you would have said, "Oh my goodness, we're going back into the soup." And yet, what we've seen in March early March data, is we're rebounding nicely from what now appears to have been a weather-related hit, and it was hard, uh, especially given the difficulties in Texas. So we're rebounding. In fact, if you look at the Philly Fed, that's the very first indicator that comes out. It's an indicator of real economic activity, volume growth. And that has not been this strong since 1994. Think about that, 27 years ago. Uh, so we're not in uncharted territory, but the rebound that we're seeing here is enormous, and I think it's a reaction to supply chain issues. I think we should start worrying about double ordering, triple ordering, and ultimately an inventory problem. But so far, we're nowhere near that. Uh, this kind of environment, though, does elicit that kind of behavior. Employment, the employment report, which is the first major report, much stronger than expected. The expectation for non-farm payroll was an increase of 660,000, and the actual increase was 916,000. What's more as interesting to me is at the same time, the average work week went up significantly. Normally, first of all, it rarely changes. When it does, it's usually zero point 0.1 hours in any given month. This last month, it was up zero point 0.2 hours. So I think companies are, again, still scrambling to keep up with demand. And we're now seeing that demand is getting another push from the stimulus check. So in February, the saving rate dropped significantly to a little over 13%. But we think that was temporary and that it is going to go back above 20%. So again, the consumer has a lot of firepower here. And we're also seeing shortages, labor shortages crop up. I know that Chairman Powell is worried about employment, and I do believe there has been a lot of displacement, but something called the JOLT index, it's a job openings index, it is now near a record high. So the record high was in November of 2018, and that was 7.6 million jobs unfilled. Either there's a skill mismatch or they're not paying enough. Uh, and at the low last year, it was 4.8 million. Uh, so even that was high by historical standards. So I think we are going to start talking about labor shortages and fears about wage inflation in the near future. So that's an interesting dynamic. I think the summary of what's going on in the economy is that we're in a V-shaped recovery. I don't think there's anyone debating that anymore. And excuse me, the question we're facing more now is on the cost side, margins. Uh, is labor inflation going to pick up in response to these shortages? Taxes are going up. That's an automatic. Debt service is probably going up. Spreads in the bond market, meaning the difference between high quality company yields and lower company quality company yields, was a very narrow spread. Uh, and we believe that is going to change uh, given the confusion and turmoil that I'm going to describe in a minute. And of course, the other cost factor here is materials. Commodity prices have been soaring. Uh, One of the dampeners out there in terms of inflation is the dollar. It is doing what I think many did not expect. It's going up. And so that's a counterforce against inflation, as is productivity. With strong growth in a V-shaped recovery, we will see strong productivity gains. So those two will be fighting inflation, whereas labor, taxes, and interest rates and material prices will all be uh, tending to dampen margins. So it'll be a dueling match here. We'll see what happens. Adding to the confusion, and you've heard me speak of this before, is the deflationary impulse that we see coming out of inflation. That's good deflation, and it's going to stimulate unit growth, which again is reinforcing in terms of productivity growth. There is also bad deflation at work. And we think the bad deflation is going to hit those companies that are in harm's way because of innovation. So this is the creative destruction that we're talking about, and especially those companies who have not prepared for the new world and have really tried to satisfy very short-term oriented shareholders. And what that meant is after the tech and telecom bust and the 0809 meltdown, shareholders became very short term in their focus. They wanted their profits and they wanted them now. They wanted their dividends and they wanted them now. And so, what a lot of companies did to satisfy those shareholders was leverage up, actually take on debt in order to buy back their shares and keep their earnings growth going, earnings per share. They also did that to pay dividends. And they were not investing enough in innovation. And so, what we're going to see out of those companies, maybe not this year, but over time, is deflation, the bad kind. They're going to have to cut prices to move inventory that is going to become obsolete anyway. And they'll have to cut prices to service their debt. Other companies who are on the right side of change and have prepared for the new world are going to do very well indeed. So I think the markets, the equity markets and the bond market are going to become confused at these dueling forces. And